Hello, everyone. My name is Tiara Davis, and I will be reading the Candlestick Trading Bible invented by Munehisa Homma, the most successful trader in history. Now, I will not be reading the table of contents for you. I'm actually just going to hop right in. Introduction. The Candlestick Trading Bible is one of the most powerful trading systems in history. It was invented by Homma Munehisa. I don't even know if I'm saying that right, but the father of candlestick chart patterns. This trader is considered to be the most successful trader in history. He was known as the god of markets in his days. His discovery made him more than 10 billion in today's dollar. I have spent 10 years compiling, testing, organizing, and consistently updating this method to create my own new version, which is considered to be the easiest and most profitable trading system. The Candlestick Trading Bible is the trading method that is going to finally take your trading to where it should be: consistent, profitable, easy, and requiring very little time and effort. This trading system is based on Japanese candlestick patterns in combination with technical analysis. All what you have to do is to spend as much time as you can to master the method that I am going to share with you and use it to trade any financial market. Learning Japanese candlestick is like learning a new language. Imagine you got a book which is written in a foreign language. You look at the pages, but you get nothing from what is written. The same thing when it comes to financial markets. If you don't know how to read Japanese candlesticks, you will never be able to trade the market. Japanese candlesticks are the language of financial markets. If you get the skill of reading charts, you will understand what the market is telling you, and you will be able to make the right decision in the right time. The easy to follow strategies detailed in this work will provide you with profit making techniques that can be quickly learned. More importantly, learning the principles of market psychology underlying the candlestick methodology will change your overall trading psyche forever. The Candlestick Trading Bible has already proven itself. Fortunes have been made using the Japanese candlestick strategies. I congratulate you on taking the first step in your trading education. You are on the right path to become a better trader. However, this is actually just the beginning of your trading career. After finishing this ebook, the real work begins. Don't read this ebook very fast. This is not a novel. You should take your time to understand all the concepts I discussed. Take your notes and go back from time to time to review the strategies I shared with you. Remember, this is an educational work that will teach you professional methods on how to make money trading financial markets. If you got the skills that I shared with you here, you will change completely your life and the life of people around you. Overview. The ebook is divided into the following sections. 1. Candlesticks anatomy. Just as humans, candlesticks have different body sizes, and when it comes to trading, it's important to check out the bodies of the candlesticks and understand the psychology behind it. That's what you will learn in this section. 2. Candlestick patterns. Candlestick patterns are an integral part of technical analysis. Candlestick patterns emerge because human actions and reactions are patterned and constantly repeated. In this section, you will learn how to recognize the most important candlestick patterns, the psychology behind its formation, and what do they indicate when they form in the market. 3. The market structure. In this section, you will learn how to identify trending markets, ranging markets, and choppy markets. You will learn how these markets move and how to trade them professionally. You will also learn how to draw support and resistance and trend lines. 4. Time frames and top-down analysis. Multiple time frame analysis is very important for you as a price action trader. In this section, you will learn how to analyze the market using the top-down analysis approach. 5. Trading strategies and tactics. In this section, you will learn how to trade the market using 4 price action trading strategies: the pin bar strategy, the engulfing bar strategy, the inside bar strategy, the inside bar false breakout strategy. Trades examples. I highly recommend you to master the previous section before jumping to this section, because if you don't master the basics, you will not be able to use these strategies as effective as it would be. In this section, you will learn how to identify high probability setups in the market and how to use these candlestick patterns in trending markets and ranging markets to maximize your profits. 6. Money management. In this section, you will learn how to create a money management and risk control plan that will allow you to protect your trading capital and become consistently profitable. History of candlesticks. Now, before I start reading this, I just want y'all to know that a lot of the names in here I might butcher, so please forgive me. Candlesticks have been around a lot longer than anything similar in the Western world. The Japanese were looking at charts as far back as the 17th century, whereas the earliest known charts in the U.S. appeared in the late 19th century. Rice trading had been established in Japan in 1654, with gold, silver, and rapeseed oil following soon after. Rice markets dominated Japan at this time, and the commodity became, it seems, more important than hard currency. Munehisa Homma, also known as Sakyu Honma, a Japanese rice trader born in the early 1700s, is widely credited as being one of the early exponents of tracking price action. He understood basic supply and demand dynamics, but also identified the fact that emotion played a part in the setting of price. He wanted to track the emotion of the market players, and this work became the basis of candlestick analysis. He was extremely well respected to the point of being promoted to samurai status. The Japanese did an extremely good job of keeping candlesticks quiet from the Western world right up until the 1980s, when suddenly there was a large cross-pollination of banks and financial institutions around the world. This is when Westerners suddenly got wind of these mystical charts. Obviously, this was also about the time that charting in general suddenly became a lot easier due to the widespread use of the PC. In the late 1980s, several Western analysts became interested in candlesticks. In the UK, Michael Feeney, who was the head of TA in London for Sumitomo, began using candlesticks in his daily work and started introducing the ideas to London professionals. In December 1989 edition of Futures magazine, Steve Nissen, who was a technical analyst at Merrill Lynch in New York, produced a paper that showed a series of candlestick reversal patterns and explained their predictive powers. He went on to write a book on this subject, and a fine book it is too. Thank you, Messrs. Feeney and Neeson. Since then, candlesticks have gained in popularity by the year, and these days they seem to be the standard template that most analysts work from. Why candlesticks are important to your trading analysis. Candlesticks are important to your trading analysis because it is considered as a visual representation of what is going on in the market. By looking at a candlestick, we can get valuable information about the open, high, low, and the close of price, which will give us an idea about the price movement. Candlesticks are flexible. They can be used alone or in combination with technical analysis tools such as the moving averages and momentum oscillators. They can be used also with methods such as the Dow theory or the Elliott wave theory. I personally use candlesticks with support and resistance, trend lines, and other technical tools that you will discover in the next chapters. The human behavior in relation to money is always dominated by fear, greed, and hope. Candlestick analysis will help us understand these changing psychological factors by showing us how buyers and sellers interact with each other. Candlestick Candlesticks provide more valuable information than bar charts, using them in a win-win situation because you can get all the trading signals that bar charts generate with the added clarity and additional signals generated by candlesticks. Candlesticks are used by most professional traders, banks, and hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. They can take your money easily if you don't understand the game, even if you can trade $100,000 trading. Even if you can trade $100,000 trading account, you can't move the market. You can't control what is going in the market. Using candlestick patterns will help you understand what the big boys are doing and will show you when to enter, when to exit, and when to stay away from the market. What is a candlestick? Japanese candlesticks are formed using the open, high, low, and close of the chosen time frame. If the close is above the open, we can say that the candlestick is bullish, which means that the market is rising in this period of time. Bullish candlesticks are always displayed as white candlesticks. The most trading platform use white color to refer to bullish candlesticks, but the color doesn't matter. You can use whatever color you want. The most important is the open price and the close price. If the close is below the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candlesticks, but this is not a rule. You can find different colors used to differentiate between bullish and bearish candlesticks. The filled part of the candlestick is called the real body. The thin lines poking above and below the body are called shadows. The top of the upper shadow is the high. The bottom of the lower shadow is the low. Candlestick body sizes. Candlesticks have different body sizes. Long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during this period of time. Conversely, if there is a bearish candlestick in which the open is above the close with a long body, this means that the selling pressure controls the market during this chosen time frame. Short and small bodies indicate a little buying or selling activity. Candlestick shadows / tails. The upper and lower shadows give us important information about the trading session. Upper shadows signify the session high. Lower shadows signify the session low. Candlesticks with long shadows show that trading action occurred well past the open and close. Japanese candlesticks with short shadows indicate that most of the trading action was confined near the open and close. If a candlestick has a long upper shadow and short lower shadow, this means that buyers flex their muscles and bid higher prices. But for one reason or another, sellers came in and drove price back down to end the session back near its open price. If a Japanese candlestick has a long lower shadow and short upper shadow, this means that sellers flashed their washboard abs and forced price lower. But for one reason or another, buyers came in and drove prices back up to end the session back near its open price. Candlestick patterns. Candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable setups. A research has confirmed that candlestick patterns have a high predictive value and can produce positive results. I personally trade candlestick pattern for more than 20 years. I can't really switch to another method because I tried thousands of strategies and trading methods with no results. I'm not going to introduce you to a holy grail. This trading system works, but be prepared to lose some trades. Losing is a part of this game. If you are looking for a 100% winning system, I highly recommend you to stop trading and go look for another business. Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you don't speak the language. How could you live if you can't even say a word? It's tough, right? The same thing when it comes to trading. If you know how to read candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trader's behavior. This skill will help you better enter and exit the market in the right time. In other words, this will help you act differently in the market and make money following the smart guy's footprints. The candlestick patterns that I'm going to show you here are the most important patterns that you will find in the market. In this chapter, I'm not going to show you how to trade them because this will be explained in details in the next chapters. But what I want you to do is focus on the anatomy of the pattern and the psychology behind its formation, because this will help you get the skill of identifying easily any pattern you find in the market and understand what it tells you to do next. If you can get this skill, you will be ready to understand and master the trading strategies and tactics that I'm going to teach you in the next chapters. The engulfing bar candlestick pattern. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. The engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. The bearish engulfing is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. See the illustration below. This is how a bearish engulfing bar pattern looks like on your charts. This candlestick pattern gives us valuable information about bulls and bears in the market. In case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. See the example below. As you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. You can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm your entries. As you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. You can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm your entries. We will talk about this in detail in the next chapters. Right now, I just want you to open your charts and try to identify all bearish candlestick patterns that you find. The Bullish Engulfing Bar pattern. The Bullish Engulfing Bar consists of two candlesticks. The first one is the small body, and the second is the engulfing candle. See the illustration. The bullish engulfing bar pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation bottom. See the example below. The example above shows us clearly how the market changes directions after the formation of a bullish engulfing bar pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What's important is that the smaller one is totally engulfed by the second candlestick. Don't try to trade the market using this price action setup alone because you will need other factors of confluence to decide whether the pattern is worth trading or not. I will talk about this in the next chapters. What I want you to do now is to get the skill of identifying bearish and bullish engulfing bar on your charts. This is the most important step for the moment. The Doji candlestick pattern. Doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There is no one in control of the market. See the example below. As you see, the opening price is the same as the closing price. This signal means that the market didn't decide which direction it will take. When this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. See another example below to learn more. The chart above shows how the market changed directions after the formation of the Doji candlestick. The market was trending up. That means that buyers were in control of the market. The formation of the Doji candlestick indicates that buyers are unable to keep price higher and sellers push the price back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember always that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves higher or lower. When it is found at the bottom or at the top of a trend, it is considered as a sign that a prior trend is losing its strength. So if you are already riding that trend, it's time to take profits. It can also be used as an entry signal if it is combined with other technical analysis. The Dragonfly Doji Pattern. The Dragonfly Doji is a bullish candlestick pattern which is formed when the open, high, and close are the same or about the same price. Which characterizes the Dragonfly Doji is the long lower tail that shows the resistance of buyers in their attempt to push the market up. See the example below. The illustration above shows us a prefect Dragonfly Doji. The long lower tail suggests that the forces of supply and demand are nearing a balance and that the direction of the trend may be nearing a major turning point. See the example below that indicates a bullish reversal signal created by a Dragonfly Doji. In the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the Dragonfly Doji with the long lower tail shows us that there is a high buying pressure in the area. If you can identify this candlestick pattern on your chart, it will help you visually see when support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. But as I always say, you can't trade candlestick pattern alone. You will need other indicators and tools to determine high probability Dragonfly Doji signals in the market. The Gravestone Doji. The Gravestone Doji is the bearish version of the Dragonfly Doji. It is formed when the open and close are the same or about the same price. What differentiates the Gravestone Doji from the Dragonfly Doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. See the example below. The image above illustrates a perfect gravestone doji. This pattern indicates that while buyers were able to push prices well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. This is interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. See another illustration below. The chart above shows a gravestone doji at the top of an uptrend after a period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. As a trader, you will need additional information about the placement and context of the gravestone doji to interpret the signal effectively. This is what I will teach you in the next chapters. The Morning Star. The Morning Star pattern is considered as a bullish reversal pattern. It often occurs at the bottom of a downtrend and it consists of 3 candlesticks. The first candlestick is a bearish, which indicates that sellers are still in charge of the market. The second candle is a small one, which represents that sellers are in control, but they don't push the market much lower, and this candle can be bullish or bearish. The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. The Morning Star pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of a downtrend near a support level, It is interpreted as a powerful trend reversal signal. See the illustration below. The chart above helps us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produces indecision in the market. The second candle could be a doji or any other candle. But here, the doji candle indicated that sellers are struggling to push the market lower. The third bullish candle indicates that buyers took control from sellers and the market is likely to reverse. This is how professional traders analyze the market based on candlestick patterns. And this is how you will analyze financial markets if you can master the anatomy of candlestick patterns and the psychology behind their formations. The evening star pattern. The evening star pattern is considered as a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern consists of 3 candlesticks. The first candle is a bullish candle. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlesticks really. The third candle is a large bearish candle. In general, the evening star pattern is the bearish version of the morning star pattern. See the example below. The first part of an evening star is a bullish candle. This means that bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that buyers are still in control, but they are not as powerful as they were. The third bearish candle indicates that the buyers' domination is over, and a possible bearish trend reversal is likely to happen. See another chart that illustrates how the evening star could represent a significant trend reversal signal. As you can see, the market was trending up. The first candle in the pattern indicates a long move up. The second one is a short candle indicating price consolidation and indecision. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick, gapping lower than the previous candlestick, indicating a confirmation of the reversal and the beginning of a new trend down. The hammer/pin bar. The hammer candlestick is created when the open high and close are roughly the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. See the illustration below to see how it looks. The hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. This candle forms when sellers push the market lower after the open, but they get rejected by buyers, so the market closes higher than the lowest price. See another example below. As you can see, the market was trending down. The formation of the hammer/pin bar was a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers was trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure, which results in a trend reversal. The most important to understand is the psychology behind the formation of this pattern. If you can understand how and why it was, you will be able to predict the market direction with high accuracy. We will talk about how to trade this pattern and how to filter this signal in the next chapters. The shooting star / bearish pin bar. The shooting formation is formed when the open low and close are roughly the same price. The candle is characterized by a small body and a long upper shadow. It is the bearish version of the hammer. Professional technicians say that the shadow should be twice the length of the real body. See the example below. The illustration above shows us a perfect shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. The psychology behind the formation of this pattern is that buyers tried to push the market higher, but they got rejected by a selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. See another example below. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of the uptrend move and the beginning of a new downtrend. This candlestick pattern can be used with support and resistance, supply and demand areas, and with technical indicators. The shooting star is very easy to identify, and it is very profitable. It is one of the most powerful signals that I use to enter the market. In the next chapters, I will talk about it in details, and I will show you step by step how to make money trading this price action pattern. The Harami pattern, also known as the inside bar. The Harami pattern / pregnant in Japanese is considered as a reversal and continuation pattern, and it consists of two candlesticks. The first candle is the large candle. It is called the mother candle, followed by a smaller candle, which is called the baby. For the Harami pattern to be valid, the second candle should close outside the previous one. The candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. See an example below. As you see, the smaller body is totally covered by the previous mother candle. Don't bother yourself with the colors. The most important is that the smaller body closes inside of the first bigger candle. The Harami candle tells us that the market is in an indecision period. In other words, the market is consolidating. So buyers and sellers don't know what to do, and there is no one in control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join the trend. And if it occurred at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal signal. Look at another example below. In the chart above, you can see how the trend direction changes after the Harami pattern formation. The first bullish Harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly, price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish Harami is the opposite of the bullish. This one occurred at the top of an uptrend, indicating that buyers' domination is over and the beginning of a downtrend is possible. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal. with the direction of the market. We will study in detail how to trade this pattern, either as a reversal pattern or as a continuation pattern in the next chapters. The tweezers, tops and bottoms. The tweezers top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezers bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. See the example below. The tweezers top formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick. And the tweezers bottom formation consists of two candlesticks as well. The first candle is bearish followed by a bullish candlestick. So we can say that the tweezers bottom is the bullish version of the tweezers top. The tweezers top occurs during an uptrend when buyers push the price higher. This gave us the impression that the market is still going up, but sellers surprised buyers by pushing the market lower and closed down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezers bottom happens during a downtrend. When sellers push the market lower, we feel that everything is going all right. But the next session price closes above or roughly at the same price of the first bearish candle, which indicates that buyers are coming to reverse the market direction. If this price action happens near a support level, it indicates that a bearish reversal is likely to happen. The chart above shows us a tweezers bottom that occurs in a downtrend. The bears pushed the market downward on the first session. However, the second session opened where prices closed on the first session and went straight up, indicating a reversal buy signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of a candlestick. Try to understand the psychology behind its formation. This is the most important. Because if you can understand why it was formed, you will understand what happened in the market. And you can easily predict the future movement of price. Candlestick Patterns exercise. Now, I think that you get some information about Japanese candlesticks. You know the anatomy of each candlestick and the psychology behind its formation. Let's take this exercise to test your knowledge and see if you still remember all of the candlesticks we talked about. Look at the chart below and try to find the name of each candlestick number and the psychology behind its formation. If you can easily identify these candlestick patterns and you understand why they are formed, you are on the right path. But if you still struggle to identify these patterns, you will have to start learning about them again till you feel like you mastered them. Let's try to answer the questions concerning the candlestick patterns on the charts above. 1. Bullish harami pattern / inside bar. The formation of this candlestick pattern indicates indecision in the market. In other words, the market was consolidating during this session. 2. Bullish tweezers. The market was trading up. Sellers tried to push the market lower, but the reaction of the buyer was more powerful. This pattern represents the battle between sellers and buyers to take control of the market. 3. Engulfing bar. Sellers were engulfed by buyers. This indicates that buyers are still willing to push the market higher. 4. Engulfing bar. 5. Engulfing bar. 6. Engulfing bar. 7. Harami pattern. This pattern shows us that the market enters in a consolidation phase during this session. So buyers and sellers are in an indecision period, and no one knows who is going to be in control of the pattern or of the market. Let's take another exercise. Look at the chart below and try to figure out these candlestick patterns. Answers: 1. Bullish Engulfing Bar. 2. Hammer. 3. Hammer, which is the large body, plus the smaller body, which is the baby, equals Harami pattern. 4. Bullish Engulfing Bar. Please, I want you to open your charts and do this homework over and over again. You will see that with screen time and practice, you will be able to look at your charts and understand what the candlesticks tell you about the market. Don't worry about how to enter and exit the market for the moment. Take your time and try to master the candlestick patterns discussed in the previous chapters. In the next chapters, I will arm you with techniques that will help you identify the best entry and exit points based on the candlestick patterns in combination with technical analysis. Trust me, these price action strategies will turn you from a beginner trader who struggles to make money in the market into a profitable price action trader. The market structure. One of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior. And if you can master this skill, when you open your chart, you will be able to answer these important questions. What the crowds are doing, who is in control of the market, buyers or sellers, what is the right time and place to enter or to exit the market, and when you need to stay away. Through your price action analysis, you will experience 3 types of markets: trending markets, ranging markets, and choppy markets. In this chapter, you will learn how to identify every market and how to trade in it. First market, trending markets. Trending markets are simply characterized by a repeating pattern of higher highs and higher lows in an uptrending market, and lower highs and lower lows in a downtrending market. See the example below. As you can see in the example above, the market is making series of higher highs and higher lows, which indicates that the market is uptrending. You don't need indicators to decide if it is bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. Look, another example of a downtrend market. The example above shows a bearish market. As you can see, there are a series of higher lows and lower lows, which indicates an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing series of higher highs and higher lows, it is simply an uptrending market. Conversely, if it is making series of lower highs and lower lows, it is obviously a downtrending market. According to statistics, trends are estimated to occur 30% of the time. So while they are in motion, you've got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames such as 4 hours, the daily or the weekly time frame. Never try to use smaller time frames to determine the market structure. How to trade trending markets. If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for a buying opportunity because you have to trade with the trend. And if the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Trending markets are characterized by two important moves. The first move is called the impulsive move, and the second one is called the retracement move. See the example below to understand what I'm talking about. As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you will think of buying. But as you can see, the market is making two different moves. The first move is an impulsive move, and the second one is a pullback or a retracement move / corrective move. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend market at the beginning of a retracement move, they get caught by professional traders and they don't understand why the market hit their stop loss before moving in the predicted direction. See another example of a bearish trend. The illustration above shows a downtrend market. As you can see, the best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell in the retracement move, you will be trapped by professional traders and you will lose your trade. Now, we know how to identify downtrends and uptrends and how to differentiate between an impulsive move and a retracement move. This is very important for you as a price action trader to know. But the most important question is how to identify the beginning of the impulsive move to enter the market in the right time with professional traders and avoid being trapped by the retracement move. To predict the beginning of the impulsive move in a trending market, you have to master drawing support and resistance levels. So what are support and resistance levels and how to draw them on our charts? This is what we will see in the next chapter. Support and resistance levels. Support and resistance are proven areas where buyers and sellers find some of equilibrium. They are major turning points in the market. Support and resistance levels are formed when prices reverse and change direction, and price will often respect these support and resistance levels. In other words, they tend to contain price movement until, of course, price breaks through them. In trending markets, support and resistance are formed from swing points. In an uptrend, the previous swing point acts as a support level, and in a downtrend, the old swing point acts as a resistance level. See the example below to learn more. The illustration above shows how the previous swing point acts as a support level after the breakout. When the market makes the retracement move, it respects the previous swing point / support level, which will represent the beginning of another impulsive move. As you can see, when the market tests the previous swing point / support level, it goes up again. By drawing a support level in an uptrend market, we can predict when the next impulsive move will take place. Let's see another example of a downtrend market. The illustration above shows us how the market respects resistance levels. When price approaches the previous swing point / resistance level, the market makes an impulsive move. If you understand how price action acts in a trending market, you will predict with high accuracy when the next impulsive move will begin. Another way to catch the beginning of an impulsive move is by drawing trend lines. This is another technical skill that you have to learn if you want to identify key linear support and resistance levels. Let me explain to you first, what do trend lines mean? Quite often, when the market is on the move, making new swing highs and lows, price will tend to respect the linear level, which is identified as a trend line. Bullish markets will tend to create a linear support level, and bearish markets will form a linear resistance level. How to draw trend lines. To draw a quality trend line, you will need to find at least 2 minimum swing points and simply connect them with each other. The levels must be clear. Don't try to force a trend line. Don't use smaller time frames to draw trend lines. Use always the 4-hour and the daily time frames to find obvious trend lines. We will try to focus right now on how to draw them in a trending market. Our purpose is to identify the beginning of impulsive moves in a trending market. In the next chapter, I will explain to you in detail how to trade trend lines in combination with our price action trading setups. See an example of how to draw trend lines in a downward market. As you can see, the market respects the trend line, and when price approaches it, the market reverses and continues in the same direction. When the market moves this way, trend lines help us to anticipate the next impulsive move with the direction of the market. Look at another example of an uptrend market. As you can see, the market respects the trend line, and by drawing it the right way, we can easily predict the next movement upward. This is all what we can say about trending markets. I think it's clear and simple. Now, what I want you to do is to open your charts and try to find trending markets. Find previous swing points, support and resistance, and try to find trend lines as well. This exercise will help you understand how trending markets move and how to predict high probability entries in the market. The ranging market. Ranging markets are pretty straightforward. They are often called sideways markets because their neutral nature makes them appear to drift to the right horizontally. When the market makes a series of higher highs and higher lows, we can say that the market is trending up. But when it stops making these consecutive peaks, we say that the market is ranging. A ranging market moves in a horizontal form where buyers and sellers just keep knocking price back and forth between the support and the resistance levels. See the example below. The chart above shows a ranging market. As you can see, the price is bouncing between horizontal support and resistance levels. The difference between trending markets and ranging markets is that trending markets tend to move by forming a pattern of higher highs and higher lows in case of an uptrend, and higher lows and lower lows in case of a downtrend. But ranging markets tend to move horizontally between key support and resistance levels. Your understanding of the difference between both markets will help you better use the right price action strategies in the right market conditions. Trading ranging markets is completely different from trading trending markets because when the market is ranging, it creates equilibrium. Buyers are equal to sellers, and there is no one in control. This will generally continue until the range structures broke out and a trending condition start to organize. The best buying and selling opportunities occur at key support and resistance levels. There are 3 ways to trade ranging markets. I'm not going to go into detail because what I want you to get here is the skill to look at your charts and decide whether the market is trending or ranging. In the next chapters, I will go into detail and I will give the trading tactics and strategies that you will use to trade trending or ranging markets. If you can't differentiate between ranging markets and trending markets, you will not know how to use these price action strategies. The first way to trade ranging markets is by waiting for price to approach support and resistance levels. Then you can buy at key support levels and sell at key resistance levels. See the example below. As you can see, the market is moving horizontally. In this case, the best buying opportunities occur at the support level, and the best selling opportunities occur at the resistance level. The second way of trading ranging markets is by waiting for the breakout from either the support level or the resistance level. When the market is ranging, no one knows what is going to happen. We don't know who is going to be in control of the market. This is why you have to pay attention to the boundaries. But when one of the players decide to take control of the market, we will see a breakout of the support or the resistance level. The breakout means that the ranging period is over and the beginning of a new trend will take place. See the example below. As you can see, the market was trading between support and resistance levels, and suddenly the price broke out of the resistance levels. This indicates that the beginning of a trend is likely to happen. So the best way to enter is after the breakout. It's important to remember that range boundaries are often overshot, giving the illusion of a breakout. This can be very deceptive, and it does trap a lot of traders who position into the breakout. The third way to trade ranging markets is to wait for a pullback after the breakout of the support or the resistance level. The pullback is another chance to join the trend for traders who didn't enter in the breakout. See the example below. As you can see in the chart above, the market was ranging. Price breaks out of the resistance levels to indicate the end of the ranging period and the beginning of a new trend. After the breakout, the market comes back to retest the resistance level that becomes support before it goes up. The pullback is your second chance to join the buyers if you miss the breakout. But pullbacks don't always occur after every breakout. When it occurs, it represents a great opportunity with a good risk to reward ratio. What you have to remember is that a ranging market moves horizontally between the support and the resistance level. These are the key levels that you have to focus on. The breakout of the support or the resistance level indicates that the ranging period is over. So you have to make sure that the breakout is real to join the new trend safely. If you miss the breakout, wait for the pullback. When it occurs, don't hesitate to enter the market. When you are trading ranging markets, always make sure that the market is worth trading. If you feel like you can't identify the boundaries, which are the support and resistance, this is a clear indication of a choppy market. In Forex, choppy markets are those which have no clear directions. When you open your chart and you find a lot of noise, you can't even decide if the market is ranging or trending. You have to know that you are watching a choppy market. This type of market can make you feel very emotional and doubt your trading strategies as it starts to drop in performance. The best way to determine if a market is choppy is just by zooming out on the daily chart and taking in the bigger picture. After some training, screen time, and experience, you will easily be able to identify if a market is ranging or it is a choppy market. Here's a good example of a choppy market that is not worth trading. Notice in the chart above, the price action in the highlighted area is very choppy, and it is moving sideways in a very small, tight range. This is a sign of a choppy market that you should stay away from. If a market is choppy, in my opinion, it is not worth trading. If you try to trade it, you will give back your profits shortly after big winners. because markets often consolidate after making big moves.